The opening bell rang and liquidity vanished. Within hours, the Dow Jones contracted by 950 points, erasing weeks of gains in a single session. This chart details the technical damage. A heavy red candlestick cuts through the 50,000 support level, closing at 49,924.98. The sell-off accelerated as WTI crude spiked past $92. Headline CPI hit 4.2%, and the 10-year Treasury yield surged. The result is a compounding macroeconomic shock. Current geopolitical tensions and lagging inflation data have converged, forcing a total valuation repricing across the industrial sector. To understand if this sell-off will continue, we have to look at the bond market. The 10-year yield is the mathematical anchor for equity multiples. When it spikes to 4.548%, the present value of future earnings for every company in the Dow decreases. This diagram plots that reaction. The yield spiked precisely as the 4.2% headline CPI print hit, overshooting the Fed's target. However, the internal data tells a different story. Core CPI, stripping out volatile energy and food, remains stable and in line with estimates at 2.9%. That divergence is critical. When the headline number spikes while the core number stays flat, the inflation is isolated within commodities and transport logistics. This specific data parameter suggests the current price pressure is transitory, driven by external supply shocks rather than a structural failure of the domestic economy. Because the inflation is tied to transit and energy, equity valuations are currently held hostage by global shipping logistics rather than internal economic weakness. The physical catalyst for this market panic is the military escalation between the US and Iran, which has moved from rhetoric to direct retaliatory strikes. This map identifies the exact geographic vulnerability. The Strait of Hormuz is a narrow corridor between the Persian Gulf and the Gulf of Oman. Military friction here has immediate financial consequences, pushing Brent crude toward $94 and WTI above $92. Energy traders are pricing in the physical threat to tankers. In this specific strait, the risk of a total blockage overrides standard supply and demand metrics. Massive cargo ships and energy tankers are forced to idle, reroute, or go dark to avoid being targeted in the conflict zone. This localized military friction has effectively weaponized geography, transforming a regional dispute into a global tax on energy and shipping. The paralysis of these shipping routes has created a secondary shock: the skyrocketing cost of maritime freight and marine fuel. We can track the mathematical flow here. The disruption at the strait has caused the Drewry World Composite Index to surge by 75%. In tandem, the Shanghai Containerized Freight Index has doubled since the conflict began. Major distributors are seeing marine fuel costs increase by $500 million a month. These companies cannot absorb those costs on their balance sheets indefinitely. Instead, they pass them to the consumer, like Amazon's 3.5% logistics surcharge. This fuels the headline CPI. The 4.2% print we see today is the end result of these freight and energy costs moving through the supply chain. Geopolitical choke points compress U.S. equity valuations by forcing consumer inflation higher, which in turn drives up the risk-free Treasury yield and lowers stock prices. The Dow's trajectory for the next 7 days is inversely tethered to the 10-year Treasury yield. This dashboard maps the bearish scenario. If negotiations stall and crude exceeds $95, high yields prevent institutional buying, risking a technical breakdown below 49,900. However, a quiet bullish counterforce is already in motion. Project Freedom is maintaining the continuous transit of oil out of the Gulf through alternative channels. Kuwaiti and Asian buyers are successfully navigating the region, proving that productive capacity is actually increasing despite the headlines. This shadow logistics network allows energy prices to decouple from the political panic, which will eventually cool the headline CPI. The physical flow rate of oil barrels acts as the primary stabilizer for the bond market, providing a more reliable indicator of direction than the political rhetoric from Washington or Tehran. To find the path to a recovery rally, we have to look back at the chart and our current baseline of 49,924.98. The primary trigger for a reversal is a confirmed pullback in the 10-year Treasury yield as energy markets stabilize. Once that yield cools, institutional volume will likely re-enter the industrial and tech sectors. The immediate target for a 7-day recovery is recapturing the 50,750 level. Beyond that, the index needs to push to 51,350 to fully erase the gap from the current panic. Navigating this volatility requires tracking the entire transmission chain, where maritime logistics and Treasury yields ultimately dictate the floor for technical support.